Welcome to a crucial update on Japan's financial landscape. Today, we explore the seismic shift as 10-year JGB yields surged to 2.88%, marking the highest level since 1997. In a dramatic turn, the Bank of Japan has reported a record quarterly balance sheet drop of $146 billion. Are we witnessing the end of the cheap money era? Let's dive into the numbers that are sending shockwaves through global trading markets. So, why is this happening now? For decades, Japan has served as the cornerstone of low interest rates globally. However, as the yen plunges toward 162 against the dollar, pressure is mounting. The historical context is essential here. We are revisiting levels not seen since the Asian financial crisis of 1997. This suggests that the structural tools previously employed to suppress rates are no longer effective against relentless global inflation. The hard data paints a staggering picture. In the second quarter, the BOJ's total assets fell by $146 billion to $3.97 trillion. This marks the largest quarterly decline since quantitative tightening began in August 2024. The central bank is no longer seen as the buyer of last resort. Instead, it has effectively transitioned to being a seller in a shaky market. With JGB yields soaring, the market is realizing that the safety net has been removed, signaling an unexpected tightening cycle that few anticipated. Market reactions are intensifying. On social media platform X, participants are raising alarms. Analysts are highlighting a fundamental shift in Japan's monetary stance. Traders feel that the Ministry of Finance's interventions in January and April failed to stabilize the yen. One strategist noted that persistently low rates exert constant pressure on the currency. The only viable strategy now seems to be allowing either the yen to appreciate or yields to rise uncontrollably. Japan faces a daunting debt dilemma. With a staggering debt-to-GDP ratio of approximately 235%, the BOJ finds it challenging to raise rates without risking a fiscal crisis. Experts argue that the only option left is to leverage the currency itself. If raising rates to combat inflation is off the table, then forcing the yen to appreciate to reduce import costs becomes critical. However, this currency as a weapon strategy is a high-stakes gamble that could destabilize global carry trades. In a significant development, Finance Minister Katayama is advocating for the GPIF, the world's largest pension fund with $1.8 trillion, to increase investments in domestic bonds and stocks. This strategic shift aims to bolster the local market as the BOJ steps back. For domestic stocks, especially in the financial sector, this could create a substantial tailwind. Financial institutions like Mitsubishi UFJ may experience improved margins as yields rise and capital flows return to Japan. The ripple effects are global. As the GPIF reallocates capital from foreign assets to domestic bonds, we could witness a massive sell-off in U.S. Treasuries. This shift could increase borrowing costs not just in the United States but worldwide. The so-called yen carry trade, where investors borrow cheap yen to invest in higher-yielding assets, is now at risk of a chaotic unwind. If the yen appreciates rapidly, expect significant volatility impacting everything from U.S. tech stocks to emerging market debt. For individual investors, risk management is key. We are entering a phase of heightened volatility, where the old adage of cheap yen forever no longer holds true. Keep a vigilant eye on the 10-year JGB yield. If it significantly breaches 3%, capital repatriation could accelerate. Diversification is now more crucial than ever, as the correlation between Japanese yields and global markets tightens. It's essential to avoid over-leveraged positions that depend on a weak yen. Looking ahead, we face three potential scenarios. In the base case, JGB yields may gradually climb to 3.2% by year-end, supported by the PIF's domestic pivot, resulting in a stabilized yen around 145. In a bullish scenario for Japan, a rapid yen surge to 130 occurs as the BOJ raises rates to 0.75%, tackling inflation but slowing domestic growth. In the bearish scenario, yields could spike uncontrollably past 3.5%, causing a global liquidity shock as carry trades collapse and U.S. Treasury yields soar to 5%. To wrap up, we've witnessed JGB yields hitting 1997 highs, the BOJ's asset dump of $146 billion, and the PIF's push for domestic investment. The carry trade era is under threat. What's your strategy in this new landscape? We want to hear from you in the comments, and don't forget to subscribe to Tokyo Macro for deeper insights into the Japanese market. See you in the next video.